Okay, folks, so we're beginning to sort of wrap up some of this material that could be useful to you as you do your memo. And the idea here is we want to bring together sort of the external sector, what we call net exports, net capital flows, and money, see how all that ties together. There is some material in your textbook. Mankiw does a reasonable job. Um, I'm going to be in 378, 382. I'm going to be giving you sort of an alternative treatment. Um, Slightly different. Once again, this is for your memo. Okay, so I have always found it easier, and I think that you'll, as business people, you'll understand. First of all, remember that a central bank, just like any other bank, has a balance sheet. You learned about bank balance sheets. They have assets and liabilities. Well, the central bank of any country has a balance sheet as well with its assets and its liabilities. Okay, here is a hypothetical balance sheet for a hypothetical central bank, and I want you to notice that in terms of the assets, there are two kinds. There's the international reserves. Why do we call those international reserves an asset? Because they're essentially a claim on other countries. So those international reserves, for in the case of China, could include U.S. Treasury bills. So essentially, when China is holding a U.S. Treasury bill, it has loaning money to the United States government. Okay, so it is holding it. That is an asset from the viewpoint of the Chinese central bank, the People's Bank of China. Okay, and then there are domestic assets. These can include, for example, loans to domestic banks and government bonds. Okay, and then, of course, money is a liability. Why is money a liability? Well, look at your money. It's like we will pay the bearer. So the central bank owes the holder of those notes, for example, or the deposits. Those are liabilities of the central bank. So once again, even though we have not emphasized so much the idea of a central bank balance sheet, I think that this is sort of a new. It's a concept that's new, but it's not so new. So then let's think about what happens. Let's suppose, okay, the idea here is that all else equal, when you have an increase in assets, you will also have an increase in liabilities. Okay. So when you have an increase in international reserves, let's say, all else equal, you will have an increase in money. Now, what's going on here? Let's say that exporters are unexpectedly successful in selling their goods, and they come to the central bank with more dollars. Okay, the central bank was going to buy those dollars. Okay, and that will be part of the increase in international reserves. This is, as I believe, it's a 100 increase, and relative to the previous slide. And how does it do that? Okay, you're going to look at this, and you're going to say the way that they're buying these international reserves, these extra international reserves, is basically by printing more money and using that money to buy the international reserves. And you'd be right. This is an expansion of the money supply, and you might even be thinking of it as running the printing press to do that. That's what they're doing. Okay. There's a symmetric argument here. Let's suppose that importers suddenly decide that they need to be purchasing a little bit more. They need more dollars. Okay, so the central bank will have to sell reserves, but in the process, the money supply will go down. Okay, so there's a symmetry there. Okay, and we need to keep that in mind. Okay, so now, the next step in the chain of reasoning is just to realize that the expansion of money will mean a reduction of domestic interest rates. And we're going to slip into an ISLM model here. This is one of your this is one of the sheets that I provided. So let's suppose that initially we have an increase in the money supply, and this is coming through, let's say, let's go back to our example of very successful exports. Okay, that's going to mean an expansion of the money supply. But then you look here, okay, assuming that this is the world interest rate here, our interest rate is below the world interest rate. What's going to happen? Well, we already mentioned that if you have an open capital account, if financial instruments are free to move back and forth across borders, okay, investors will be now looking for a higher rate of return. They'll be dumping their domestic assets, which are now giving them a lower rate of return, and they will be going and purchasing world assets, and in the process, that's going to drive the domestic interest rate back up. We started off with an increase, but it's just going to be going back to no change. Okay, so we're going to get back to where we were. Okay, and that's domestic investors dump their domestic assets, their bonds. The price of those bonds go down, or the interest rate goes back up. Okay, so the final position. You're going to have an initial increase in money, but then an offsetting decrease, and the final change will be no change in the money supply. Domestic world interest rates will be kept equal. Let's just do one more little example here. Okay, well, let's go back to the balance of payments here. Okay, so let's start off with an initial example. We're starting off with net exports equal to 0, our net capital flows are equal to 0, and then all of a sudden, let's say that we have an increase from 400 to 500, okay? And that means all else equal, an increase in international reserves of 100, and as we showed in the previous part of this video, that will mean an initial expansion of the money supply. That will mean that the interest rates are going to be pushed down. But guess what? If we have that open capital account, that means money is going to be leaving. You're going to have some net capital outflows, and that this is going to be amount of 100. And that's exactly the amount you need to bring the interest rate back up to its world level. So that's the implication of having an open capital account. So capital controls then are a way of circumventing this last part here. It's like the money comes in and it can stay in, and that's also maybe a way that the country can build up reserves. Okay, so but once again, we've put some caveats about capital controls. Sometimes they're not totally effective. The question you have to ask is, well, did capital controls do their job? For example, what happened to reserves in China? If you take a look in my book, I'm just going to give you a little hint here, but you can see here that reserves have grown very dramatically in China, but I will leave the rest to you because this is your assignment. I hope that this has been a helpful series of videos. Thank you and good luck.